Inflation data came back much worse than expected, and this is a big deal because as long as inflation is a major problem for us, the Fed is going to continue to stay very aggressive with its monetary policy. Well, based on the severity of this inflation report, we can definitely expect that the Fed is going to get even more aggressive and for a longer period of time. And that's really what we're looking at here. Is we know the Fed is going to be aggressive because they want to bring inflation down. We know that's going to cause a housing correction, stock market crash, all that kind of stuff, economic recession of sorts. But what we're really looking at is how long is this going to take place for? How big of a correction are we going to see in the markets across the board? So with that said, there's a lot to break down in today's video. This is also going to be a lighter edited version than I typically do in my videos so that I could get it out on time. But with that said, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. The news we've all been waiting for has finally come out, and that is the latest inflation data. Now, inflation is one of the most important metrics to keep your eyes on right now, especially because it has a direct effect on the future decisions the Federal Reserve makes with its monetary policy, which that in turn has a huge effect on the economy, along with the stock market and housing market. You see, the members of the Federal Reserve are essentially the people that decide whether or not to raise interest rates or lower interest rates. I'm talking about the federal funds rate. And that has an effect on your borrowing costs for things like car loans, for credit cards. If you have a balance on your credit card, that monthly payment is going to go up if they raise interest rates. You have a HELOC, if you have a personal loan, all those things are affected when the Federal Reserve raises interest rates, and that can have an effect on slowing down the economy when they choose to raise interest rates. Well, September's inflation data just came back, and it came back worse than expected on just about every level. Starting with headline inflation. Back in August, we were sitting at 8.3% inflation. We were expecting it to come back at 8.1% for September, but it came back at 8.2%. Now, at a first glance, it might actually look like we're slowly bringing down inflation levels as it went down from 8.3 to 8.2, but in reality, we're actually manipulating the total inflation numbers because we've been artificially bringing down gas prices, which has kind of manipulated the entire total inflation number. You see, the way we brought down these gas prices artificially has been through releasing 1 million barrels a day from our strategic petroleum reserve, and that's caused gas prices to go down drastically. If you actually look closely at the numbers, you'll see that month over month, we saw it from June to July, we actually went down 7.7%. We saw it from July to August go down 10.6%, and in this latest report, we actually saw that inflation on gas actually went down another 4.9%. So you have to keep in mind that with gas going down this much, we're still seeing the total inflation number barely move at all. So imagine if gas was simply at 0%, or when it starts to go back up like it's going to, what kind of an effect that has on the overall inflation number. So that's something we've talked about that we really want to keep our eye on for the month of November, really the month of December when they report November numbers. And there's three things that are really going to affect the total inflation number. The first one is gas prices, like we talked about, because for one, the Biden administration has been releasing these million barrels a day, and that is going to stop at the end of October. In addition to that, OPEC recently announced that they're going to cut their supply by 2 million barrels, their production, of barrels of oil by 2 million a day as well. So that's going to continue to cause oil supply to go down, which as a result, we're going to see gas prices start to go up, and that will contribute to more inflation. Secondly, we have student loan forgiveness that still hasn't gone into effect, and that has a nice $500 billion price tag that, again, that spending contributes to more inflationary pressure. And finally, you have owner's equivalent rent, which is just simply the government's way of tracking what rent growth is doing, although it's really flawed and it's really lagging behind what real rent growth is doing. And so we're seeing that number start to catch up over time. So these three things are really going to contribute to more inflationary pressure in the coming months ahead, especially for the month of November I'm looking at. But in addition to that, we saw that month over month, although the yearly inflation actually went down 0.1%, month over month month, we actually saw an increase. We actually saw an increase last month of 0.1%. The expectations for this month were 0.2%, but they actually came in at 0.4%. So that number came in much higher than expected, but if you look a little closer at the numbers, it's interesting to see what's taking place. If we look at food, overall food is up 11.2% year over year, and it's actually up 0.8% month over month. That's for food costs. If you go down a little further, you'll see for new vehicles right here, new vehicles, they're up 0.7% month over month, 9.4% year over year. If you go a little further down, you'll see owner's equivalent rent. Now this is an interesting one to look at because it's up 6.7%. Last month it was actually up 6.3%. So again, like I said, we're seeing this growing trend of rent prices going up, even though in reality, rent prices are actually going down right now. These are lagging indicators when it comes to the government's way of tracking rent growth because it relies on homeowners to tell us what they think that they would be capable of renting their house out for, and they're only starting to catch up to what reality has been for a while now. So we're seeing that up 6.7%, another 0.8% month over month. So we've talked now about this headline inflation number, but the real number to be concerned about, that the Fed is going to be very concerned about right now, is core inflation. Now core inflation is basically your inflation not counting food or energy. Now what we saw with core inflation, the expectations were for it to come back at 6.4%. They ended up coming back at 6.6%. So again, much worse than expected for core inflation. Now to put it in context, you can see on this chart here, it shows the historic core inflation here. You see we hit a high of 6.5% in March, and since then we've been going down. We hit about 5.9% June, 5.9% July, but now things are going back up again. We hit 6.3% in August, we hit 6.6% in September, and it's really the highest levels we've seen not only just this year, but 6.6% is the highest levels of core inflation we've hit in over 40 years, taking us all the way back to 1982. So this is a big problem, especially if that number continues to rise. And so we're already seeing the markets react to this data, as we've seen the 10-year Treasury climb to almost 4% at this point, and the 2-year Treasury has climbed to almost 4.5%. Now the 10-year Treasury is typically what I like to keep a close eye on because the 10-year Treasury often correlates very closely to what mortgage rates do. Typically as the 10-year Treasury yields go up, we start to see mortgage rates rise as well. And that's exactly what we've seen take place, is when they announced the inflation data, we saw the 10-year Treasury shoot up, which caused mortgage rates to shoot up. Now this is exactly what I've been telling you is going to happen, that I believe mortgage rates are going to continue to rise, that as inflation continues to be a problem, and I just told you about how I think it's going to be more problems ahead coming in November and December along the way, that's going to cause more problems with mortgage rates continuing to rise because the Fed is going to continue to have to stay aggressive, maybe get more aggressive with its monetary policy for a longer period of time. And so that's going to create higher mortgage rates, lower housing affordability, and more pain for especially the housing market. Now again, for those who haven't been following this for a while, the Fed has stated multiple times that their number one goal is fighting inflation. That's their biggest problem they want to solve because that helps every single American out that's struggling right now with cost of living. So they've stated multiple times publicly that they're not going to stop fighting inflation until inflation gets down to 2% levels. And they don't care if that causes an economic recession. They don't care if it causes a housing crash. That doesn't matter. That's not their priority to prop those things up anymore. Now their priority is simply bringing down inflation. So whenever they see stuff like this coming out that inflation is still hot, it's really bad news because it means that what they're doing so far hasn't worked, and so they're going to have to get even more aggressive than they've already been. The Fed has even emphasized that they really don't want to follow the same mistakes they made back in the early 80s when they ended up pivoting too soon, lowering interest rates too soon, and that contributed to a longer period of an economic recession, and that was the worst economic recession we've actually seen since the Great Depression. So obviously they don't want that to happen, and so they need to get on top of this inflation as soon as possible. So when this data comes back showing that they're still not in control of this inflation, that's a big problem, and they're going to need to get way more aggressive in order to tackle this problem. Otherwise, there's a very high likelihood that we could experience an economic recession for a much longer period of time. We're already seeing signs that investors believe the Federal Reserve is going to get more aggressive than they've been. Originally, we thought there was a chance of a 50 or a 75 basis point rate hike in November. Now it's almost a sure thing that the minimum amount would be a 75 basis point rate hike. That's basically a 0.75% 0.5% increase, but some even believe we may even see a full 1% increase. And December is very likely to be a minimum 0.5% increase as well, and so by 2023, if inflation continues to be a problem, there's a very good chance we could start to see the federal funds rate go way above the 5% range, which is well beyond expectations that the Fed released in their last report. If that ends up happening and inflation continues to be a problem, which I'm anticipating it will be, especially in the coming months ahead, then we're going to continue to see more severe price corrections across the markets, and this economic recession that we're entering into is definitely going to last for a longer period of time. So with that said, I'm going to continue to keep you up to date with what's going on, but if you enjoyed today's video and you gained some value, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know in the comments below if you have any thoughts or questions, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out-of-State Investor, and if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.